Yes, friends. Hope all is well with you. A lot of friends ask me question about if I am buying a new house and if it is really over $1 million house and I'm living in $500,000 home right now. So what should I do? Should I sell or should I rent? And that's really the question comes to me a lot, that what should I do? So I thought it would be good to share that feedback with all of you because this really question comes to my desk a lot. My name is Sheikh, and I am a local real estate developer, engineer, broker, and I've been doing this for 20 plus years, and people ask me this question a lot, and I thought I'd give you some feedback. So let's suppose you are buying $1.5 million home and you have a $500,000 or $700,000 duplex, a small home where you're moving from, and you have a pretty low mortgage rate. Chances are you have about 2, 3, 4% mortgage rate. So your interest rate is pretty low. Hence, if you sell that property, you will lose that. And then the other thing is, it's very, very important to have a second property, and I'll explain you why. In nutshell, I would say the first reaction would be that you should do your calculation carefully and probably try to keep that house and rent it instead of selling it. Now, this really even goes against me because I sell houses and I build houses. So if you are selling a second home, it's really good for my company, but I'm really telling you what is good for you. So you got to think about that. How is that other second home? What's the cash flow of it? It doesn't have a positive cash flow. That's the first question you need to answer. And then the second question you need to answer is that by keeping this house, can you afford to buy another house? So these are really the two main questions you need to ask yourself to make decision. So let's talk about the cash flow and positive cash flow. So let's say you have a $700,000 value townhouse and you have $200,000 equity or more equity, but let's say you keep $200,000 equity in it, and now you have $500,000 you have to worry about for interest. Now, if you do interest only home equity line of credit, I would really recommend doing home equity line of credit. Why? Because home equity line of credit, basically you can pay off anytime. You can pay the other loans anytime too, but this one, you only pay the interest when you owe any money. If you pay it off, there's no penalty, and you can pay it off and you're not paying interest. And if you need the money, you can take the money. So basically, I would recommend home equity line of credit. And the other thing is, home equity line of credits are far cheaper than a conventional loan if you really do your research right and your negotiation right. So basically, now you have $500,000, you have to pay interest, and if you have 3%, that's really $15,000 a year. So if you're paying $15,000 a year, it's about $1,200 or so per month, or even less. So now you're basically have to see that what you can rent for. A $700,000 condo, nowadays you can rent for around $4,000 a month in Northeast, depending on where the area is. And that's the reason you need to just follow this guideline and do your own calculation in your region. So now let's say you're paying $1,200 of mortgage and you are getting $4,000 a month rent. And then you add some taxes. Let's say you're paying $500 a tax. So that's $17, and let's say you're paying another $100 for insurance and another couple of $100 for maintenance. So your total expense is $2,000, whereas you're getting $4,000 a month. That being said, it's a very good positive cash flow. Why would you ever want to sell that home? Because mortgage is getting paid by your tenant. You will own this property 100% free and clear in 15 to 30 years, and yet you have another asset. So in my humble opinion, if that's the case, you have a very, very good equity. You have very good asset. You have a very positive cash flow asset. Now, I understand that there's no free lunch, and there are some other nuance goes with the rental, that you have to manage the tenant and all that. And I have another video that how do you really qualify a tenant and how do you manage a tenant, and we can show a link here. There are a couple of videos we have in that regard, and you should watch those. But again, like I said, there's no free lunch. Even if you manage a portfolio for $500,000 or $200,000, whatever cash you have, then you still really have to do something. And there are risks involved. There is, of course, real estate in the long run. If you look at 30-year, 40-year, 20-plus year long run, basically real estate is the best investment. The property value increase, plus you're getting rent. Then there are other benefits. Those are tax benefits, for example, depreciation. So you can depreciate every single year. So there are a lot of other benefits. I can't go in all those benefits in this video, but I just explain you that you're getting $2,000 a month, and yet you are really keeping the house. Now you may ask me, but I need that $700,000 to pay off my other house. But if you really truly need all that $700,000 and you basically have no other leverage and you cannot really get a loan, that's a different story. But in my humble opinion, not only that leverage would be there for you, but also you can get a loan. So like I said, if it's a $700,000 and you owe $500,000, you don't owe anything. A lot of times people don't owe anything. You do get a home equity line of credit and you basically rent that. Now you got home equity line of credit on your existing home before buying a new home. And now this is a home equity line of credit toward an asset where you already have an equity. So this does not go into your burden. And now if you have a positive cash flow, then the mortgage company will actually look at it as a positive instead of a negative that you have to support two homes, because this home is generating income. And let's say you will ask me, well, but it's not generating income now. Well, what you do is you basically get home equity line of credit approved. You take that money out. Now you have that money. And then also you can put it on the market and get some application, and you can show to the bank that this is actually an asset and it's a cash producing asset. Hence, actually, you can even qualify for more mortgage for your next home. So that's how I would do the calculation. You need to really have 2-point test. Number 1 point is basically you need to see, is it a positive cash flow? So it may not be giving you that good of a positive cash flow, the example I gave you, but is it a positive cash flow? Are you making $500 a month? Are you making $1,000 a month? Are you making any amount of money? Now, if it is a negative cash flow, let's say you are paying $2,000, but you are only getting a rent of $1,000, then please get rid of it. That's not the right investment, even if you have a good mortgage rate. So what I'm trying to say is that you basically have to look at the cash flow, and that is a positive cash flow. It's must. And then the second thing is that how do you really use that money or get that money out to pay your next house? And that really is your home equity line of credit. I hope this helped you. And if you have further questions in that regards, you can comment in the YouTube, send an email on richvmax@gmail.com, and we can have a further deeper conversation. If you're in a market, especially in this region, in Northeast, in Boston area, and Shrewsbury especially, I have beautiful subdivisions I'm building, and I'm happy to show that to you. And yet, I can help you with all these things as well, because I happen to know a few things. I am not giving you mortgage advice, interest advice, banking advice, financial advice. I'm only sharing with you my experience based on my real estate development involvement. So till next time, you have a happy, healthy life, and we'll see you soon.